If you have a 401k, an IRA, or any kind of retirement savings, I'm about to reveal could either protect your wealth or leave you financially devastated. Because Wall Street's just got unprecedented access to your retirement. Trump's August 7th executive order just opened up 90 million Americans 401k. To whom? To crypto, to private equity, and to Wall Street highest fee investments, while the US national debt explodes at the same time. Now, before Winston here starts barking about government overreach, because he does all the research around here, he's the advisor. None of the following, of course, is financial advice. Let me explain why this affects you personally. This represents the biggest change to American retirements in literally 50 years, and most people have no idea it even happened. So while Wall Street is quietly celebrating their biggest victory ever, and most people have no idea this is even happening while Wall Street is quietly celebrating their biggest victory. My name is Felix Prehn, that was Winston there, and I'm a former investment banker turned educator. I've spent years watching Wall Street extract wealth from risk. Today, I'll show you exactly what they're planning and, more importantly, how you can protect yourself and potentially profit. I'm also the founder of the Goat Academy, where we level the playing field for over 20,000 investors so far, and I'm the co-founder of Trade Vision, where we give you access to data and news you wouldn't believe is actually there. In this video, I'm going to reveal the 3 ways this executive order affects your dollars, why crypto in 401ks could be a disaster for most people, and the free banking 2.0 revolution that's coming, and the very specific investments that could actually protect you. Plus, how to position yourself before most people catch on. Because here's the brutal truth. This is not about giving you more choice. It is about transferring your money to Wall Street, while the government desperately trying to manage that huge debt hole they've got. But if you understand what's happening, position yourself now. And Wall Street, well, they're already benefiting. So grab yourself a cup of coffee, perhaps a pen and paper, and let's get cracking. So what exactly does this executive order do? Well, it affects 90 million Americans 401ks, which is roughly $10 trillion of retirement savings. Now, at the moment, these plans are mostly in mutual funds, as in Wall Street's piggy bank. They are in bonds and to some extent in ETFs and individual stocks. So this is now. Now, what's about to happen is that you can, in addition to that, now put crypto into your retirement account. You can put private equity investments in there, and also real estate, and also gold and other commodities. Now, Wall Street has 180 days to put this into practice. So this is happening right now while most Americans are completely unaware of it. But here is why this should probably terrify you. If you put your money into an ETF, like a fund, your fees, you buy something like VU, you're paying 0.03% a year. Now, these new alternative assets, they charge 2% a year plus 20% of profits. Right? That's the brave new world of private equity and hedge funds. So what does that actually mean? Well, let's just say that you've been saving quite nicely, and say you have $100,000 in your retirement account. So at the moment, you're paying $30 in fees. That's now. Well, with the new investment, you could pay $2,000 in fees plus the 20% of any profits. Can you see why they're doing this? Now, maybe you think, okay, but I'm going to get better returns here. Well, if you look at this over a longer time period, the retirement is usually a longer journey. Say over 30 years, this could cost you $200,000 to $400,000 in losses just from fees, is the fee compound. Now, the government used to warn about crypto in particular in 401ks, but the Department of Labor has just removed that very warning just 2 months before this executive order was signed. Coincidence? I don't. The coordinated plan to benefit Wall Street at your expense, my humble opinion. Let me walk you through why crypto in your retirement account is a trap. Crypto. But in your retirement account, it's a real problem. Because, Bitcoin's up, 100% or something last year, which sounds amazing, right? Who doesn't want that gain? But here's what they won't tell you in your 401k marketing. Bitcoin, and that's the most stable crypto out there, has crashed 74% or more 3 times already. So imagine you're 1 year away from your retirement and you're suddenly losing 74% of your retirement. Well, you can't wait for the recovery, can you? Because this is your retirement money. You're going to have to live off that. So what do? Well, you're screwed. You have to work longer. And you'd probably panic sell. And you're going to lock in a devastating loss forever without the benefit of time that could maybe fix that for you. And at the moment, Wall Street says there is a 50% chance, so 50-50, of a recession. Now, why does that matter? Because these alternative assets, your private equity, your cryptos, all that stuff, that performs terribly during recessions. It also becomes very illiquid, which means you won't be able to sell it. Literally, you will not be able to sell your private equity investments. Private equity company will say, I know you want to sell it. I know you want your money back, but it's our money now. We decide when we sell it. Trust me, I've been there. Literally been in that exact same scenario where I said to the private equity company, I was an investor in, I want to sell this. They said, you can't. I said, why not? They said, because we won't let you. Read the fine print. It was a 200-page contract. I was like, works now. So your money could be locked while it's up or down 70%. So this is like financial planning, disaster. Okay, maybe you think, oh, Felix is a bit worried. Okay, let me tell you this. You know a place called Michigan in the US? Michigan has a retirement system, like most states. They put $74 million into crypto. Now, they actually put it into crypto ETFs, which are very, very liquid, so they got rid of that problem. And they're a very sophisticated investor because they're a pension fund. But how much did they put into it? 2%. No more, because they understand the risk. Yeah, some of Wall Street says now maybe it should be 5%. Maybe it should even be 10%. That probably also depends on the size of that retirement fund. Retirement fund is $5 million or $10 million. You're putting 10% into that. Even if that disappears, you're still going to be all right. Your retirement fund is $100,000. You lose 10% of that. That's going to impact you, the way you live, what you do for the rest of your life. But your 401k might let you now put in 50% of your money into crypto because, you want some sort of 100% return. And they'll make a lot more money in the process. They'll make a lot more fees. You bear all the risks. That's how the system works, my friend. So why is the government doing this? Well, Wall Street donates billions of dollars to elected officials every year. That's one story to it. And the second story is simply the US has $37 trillion in debt. So how does that connect? Well, how do you deal with the debt? Well, taxes won't do it. Spending cuts won't do it. Tariffs won't do it. Let's be realistic about this. This is not a political statement. Just do the maths, right? So what does the US need to do? They need to reduce the value of the US dollar. I made some videos on that, so I'm going to keep this very, very brief. That's the only way they can reduce the real debt burden. You need lower US dollar. You need higher inflation. That's basically the solution to getting rid of debt. But they're using your retirement as the it is called the dollar replacement strategy. And how are they doing that? Well, it's a brilliant plan, actually. They're doing that with stablecoin. I'm going to have to take you down this rabbit hole. The only way you're going to understand what's happening. Now, 95% of stablecoins are US dollar backed. What does that mean? Well, it means these stablecoins, they own US debt. Because nobody wants to hold cash dollars because they don't pay you any interest. But if you hold US debt, you get that 4 to 5%. And that's very, very important when you have trillions of dollars. So every single time somebody buys a stable coin, they're actually buying US debt. So what you really want to do as the US government, you want to create more buyers for your debt. And therefore, you actually want to push lots of money into crypto. Because how do we buy crypto? Well, there is a step in between, which is the stable coin. Not stable coin, by US debt. Essentially forcing global demand for dollars, or dollar debt rather, through crypto. Rather genius if you're the government. So they turned the whole crypto revolution into a dollar preservation tool, into a US debt preservation tool, while Wall Street, who are facilitating this, are extracting fees from your retirement account. So you're not getting access to better. You are subsidizing the government. You are subsidizing the government's monetary policy. That's what you do. Now, is everything that Wall Street does bad? No, they're very good at making money. And look, you want to understand how Wall Street actually makes the real money, how they find those winning stocks. You maybe want to do that before these policy changes come in and turn everything upside down. Then come and join me, and I will teach you literally how does Wall Street find winning stocks in all markets. All markets, bear markets, crashes, rallies. Teach you that live. That's an hour and a half. And I'll do that at felixprehn.org/training. And I'll put the link down below in the description. I'll put it on the screen as well. You can just click below it. But there is more to this. There is more to it. Because we might be at the very cusp witnessing the return of free banking. Now, in the 18th century, to be precise, 1837 to 1863, banks could do what? They could print their own money. And it seemed bizarre, but these were bank-issued dollars. Now, what does the US government now permit? Something called the Genius Act, which is the Stablecoin Act. And that permits banks to issue stablecoins that are backed by US debt. So you can have the JP Morgan stablecoin, the Bank of America stablecoin, the Wells Fargo stablecoin, even PayPal stablecoin, and many, many others. And these are digital currencies that these banks can issue, and they're going to be competing for your money, your deposits with higher yields and so on. And that could actually benefit savers if you do it right. So what's the opportunity here? Well, let me tell you what smart money is. Banks that successfully launch stablecoins will dominate. Right? They will get fees on every transaction, every transfer, every conversion. And traditional banks are going to have to use those stablecoins. Now, who's already doing that? JP Morgan, of course. Bank of America is building a stablecoin infrastructure. And these are strategic positions. The banks that win that race are going to see explosive profit growth. Competitors struggle with this old legacy system of real hard money. But how do we identify which banks will win? Well, it's exactly the kind of thing that I'll teach you on Tuesday, not just for banks, but for every sector. Join me at felixprehn.org/training. But we want to figure this out before the market really catches on to this. Once everybody knows it, well, the opportunity is a little bit gone, right? That's how it works. You know this opportunity chart? You have the people here who are early. They make a lot of money. Right? And then you get the people who are doing okay because they got in sort of all right. And then you get the people who are late and they lose most of the money. And then you get this horrible little crowd back here who are just like, yeah. So where do you want to get in? You want to get in somewhere over here, right? You want to get in somewhere in the early or the okay stage. But most retail investors, unfortunately, are always late. So let me fix that for you. Are we going to fix that for you? Seriously, come and join me on Tuesday. Because if I walked you through that here, this video would become more than an hour long, and I want to be respectful of your time. But yeah, literally, we look at the banking sector, and we can look at which banks are the winners. We can do that on the basis of data. We can do that on the basis of where Wall Street's money is flowing. And we can potentially have some really nice upsides there. So come and join me there. Now, what about this whole digital gold thing? I'm, of course, talking about Bitcoin here, not about the physical gold stuff. Look, there are risks to it, but there is a bull case to be made for Bitcoin for sure. And I think everybody should probably own some, but not in your 401k. Definitely not. So why is this interesting? Because there will only ever be 21 million Bitcoins, while the government's going to print as many coins and money as it wants, and JP Morgan and everybody else is going to create as much money as they want. And how does that work? Well, it's an inflation hedge. So let me walk you through this. In 2016, a US home cost about $288,000. 288K. How many Bitcoin was that? That was 664 Bitcoins. Now, in 2024, we've had some serious housing inflation. The average home is now $435,000, but it's only 6 Bitcoin. Can you see what happened there? Money lost value, but Bitcoin increased its value by like 100 times. It not just maintains purchasing power, it really increases it, but the dollar literally lost 90% off. So what do you want to do? Well, smart people buy Bitcoin with money they can afford to lose. I would say somewhere between 5 to 15% of portfolio. If you have very little money, stick to the lower side. Not because I don't want you to win, but just because you can't afford to take the risk. If you have more money, you can be a little bit more adventurous there. And don't put it into your 401k. Your 401k should be stability, not speculation. Your Bitcoin position, anything else you do outside, that's all good and fine. Just don't do it in that. It's doing it backwards, doing it the way around, or other way around. So don't fall for it. There's a smarter way to play this transition. And I'll show you exactly how. I look at a 3-bucket approach. You have bucket number 1. And bucket number 1 is about 60% of your money. In that, you have your ETFs, your low-cost index fund, things like VOO and so on. Maybe you want to add some bonds to the mix. Maybe you want to add some dividend stocks to the mix. Make sure you understand the tax implications of that. That's your foundation. That's your sleep well at night money, right? This is your everything is going to be just fine money. So this is bucket number 1. What is bucket number 2? Well, that's a slightly smaller bucket. That might be 30% of your money. By the way, these percentages are not set in stone, but I'm giving you some guide here. And that is going to be individual stocks. It spells stocks. Bankers, we struggle with the most basic of tasks. I think we're smart. It could be some REITs. It could be some sector ETFs, sector ETF, right? So that's bucket number 2. Now, there is a third bucket. And maybe in bucket number 2, you put some of those bank winners that are going to come up. Your bucket number 3 is your speculation bucket. It's a much, much smaller bucket. Let's call that, to make the maths add up, 10%. That's where you put your Bitcoin, your crypto, your alternative assets if you must. You want private equity or whatever. That's not in your 401. You control the timing. You control the fees. You control the tax strategy. Never let Wall Street control your speculation money. So this is your speculation. Bucket 1 is your foundation. And bucket 2 is your growth bucket. And done right, bucket 2 and bucket 3 might end up much larger than bucket 1 down the road. But not because you put the money into it, because the money performed for you. So how do you implement this? Okay, let me explain that to you as well. Let's throw that in here. First thing I would do if I were you, sit down on Monday or on Sunday or whenever you have time, but make it in the next 5 days, because otherwise it'll never happen. First thing is, you want to review your 401k. You only ever want to have money in there up to the point where your employer matches it. Otherwise, don't bother. Check the fee, because 401ks are horrible for fees. And if you're paying high fees because you're in mutual funds or something like that, switch out of those. Switch into really low-cost ETFs. Your only leverage within 401k is fees. It's the only thing you can really control properly. And stop paying into it once you hit the employer match, because that's going to be terrible. And that was perhaps number 2 as well. I sort of threw that in there as well. And the second thing is, you want to have a separate investment account. Now, something like a Roth IRA is amazing for that. And then you can do in that your growth, and you can also do in that your speculation buckets. Your Bitcoin, your crypto, whatever, but you're still in control. And then number 3, learn. Investing is a skill like any other, like learning to swim. Hard at the beginning. It gets easier and easier the better your coach is. That's what I would say. So learn with me on Tuesday. Is it Tuesday? No, Wednesday, I think. FelixPrehn.org/training. I already know what day of the week it is. And put this in place before it becomes main. The best opportunities exist in the gap between policy and public awareness, and ask a few people about that. Nobody really understands this now. That's an advantage that we can have. So once mainstream media really explains this in like 100 days or whenever, the opportunity will no longer be as good. Now, this is the plan, the largest wealth transfer in American history. This is the government's plan to finance its insane levels of debt and buy their popularity. But the question isn't, in my mind, whether this will happen. The question is whether you'll be on the right side of it. Most Americans are going to wake up 5 years from now and they're going to be wondering where the heck their retirement money is. All group who understood and positioned themselves correctly. One thing I learned working in banking and knowing a lot of bankers, regular investors can and do win. They have the right information. So that's exactly what this is all about. So if you want to learn how Wall Street finds the winning stocks that benefit from this and anything else, quite frankly, before these policy changes devastate a lot of the time. Live training session this week. I'll show you the exact screening process we use and help you identify those winners. Build that policy-proof, recession-proof portfolio. Go to FelixPrehn.org/training right. Grab yourself a free. Put the link in the description below. Completely free. Spaces are limited. We will run out. And over 20,000 students have already used these. Protect their growth, protect their wealth. And most investors, well, they get sold the worst possible products, which used to be me at the worst possible time. So all you got to do is take action. Information without implementation is worthless, so don't treat this like a Netflix video. Actually do something. Register for that training session right now. And hey, if this video opened your eyes to share it, send it to somebody who might also benefit from having their eyes open. Anybody who has a retirement account, for example, they need to see happening. I'll see you live training session. If you hold any dollar assets, your savings, your 401ks, your bonds, what I'm about to reveal could either protect your wealth or leave you financially devastated. A Russian economic advisor just exposed what he claims is America's secret plan to eliminate $37 trillion in debt overnight.